So we do have a question from Andy R. You've sort of touched on it just then, Damo, but he's asking, is the tactical growth portfolio geared to take advantage of this housing boom next year, or is there more growth in companies and bonds?
No, it's not. Look, I think there's, from our investment perspective, it's we're more concerned about things getting worse before they get better. So you need to come up with an argument within this for the RBA to be cutting rates, and so for that you need to be seeing slowing, quite significantly slowing, in terms of inflation. And so there's the question about what is it that brings that about, and is that factor, so it needs to be negative economic news, and is that negative economic news bad enough that the RBA will then start cutting rates? And so that's the push-pull at the moment. And so for me, it's about saying, yeah, look, we can have this. I think it's a reasonable view that if we have a mild recession, and the economic fallout is sort of limited more in not in terms of big declines in houses, and more about other sectors of the economy, that we could see the RBA cut rates and this benign outcome. But the risk is that what does cause it is we hit the mortgage cliff, unemployment starts to jump, the rest of the world starts slowing quickly, commodity prices start falling at the same time, and we see we see things get a lot worse before you start seeing the rate cuts. And so I guess it's a question of timing. Obviously, house prices and buying houses is not the same as buying shares. You can buy shares and you can be all done in a few minutes. Houses take a lot longer in terms of the process, and so it's much easier in terms of shares to hold back and wait and have a longer term. And wait to see how things unfold before you actually jump in and make these purchases.
Awesome. And I just want to let all the viewers know, depending on your outlook of what's going to happen, across all our portfolios, we do have screens and tilts. So companies you can knock out of your portfolio depending on your views, or companies that you can actually add into your portfolio. So a way, some clients could take advantage of, if you're bearish on the Australian property market, we've got a screen where you can remove the Aussie banks or limit Australian housing exposure. And then on the other side of the coin, if you're bullish, if you think we're not going to have a recession and things are going to take off, you can add in growth stocks, for example, or global financials, or large tech stock.
Nucleus Wealth, personalised portfolios for engaged investors.